All right. Welcome to the Portfolio Monster podcast. This is the show for real estate investors who want to build serious portfolios the right way. I'm your host, Matt Martin with Matt Martin Homes. I'm a property manager and acquisition specialist with PMI Georgia. So each episode features interviews with real estate investors and industry professionals delivering real-world strategies on acquisitions, deal analysis, operations, and long-term portfolio growth. So this podcast is designed to help you build a monster portfolio so you can crush your goals, achieve financial independence, and create a lasting legacy. And in this episode, I'm here with Sean Trombetti, Sugar Sean Trombetti of Reliant.
Sugar Sean it is. Thanks, Matt.
Reliant Mortgage Solutions. And he's going to share with us some powerful new loan options to help you scale a profitable single-family portfolio across the Southeast. And just as a reminder, these podcasts are live broadcasts. And for those who register, you're welcome to share questions or comment in the chat. So Sean, welcome. Thanks for joining us today.
Oh, anytime. I love talking about real estate investing. Believe me, my people or my employees will tell you this is the number one topic. And in fact, I brought debt service ratio to the company as a big product coming down the pike. And this was a couple years ago. And we'll get into that in a second. But let me give you my background.
Okay.
I got into the origination business in 2003. And in fact, I worked for a company called First Mortgage Solutions in Atlanta. About 50% of the business was targeted toward investors. In fact, we had a spot on the radio at the time with, I think it was 750 WSB, and it was John Adams' show, and we were the sponsor. And so we did a lot of stuff with that particular radio show, including showing up at Emory University, talking about investing. So this is my true love. Come forward to 2019, I started my own company, a mortgage broker company in Marietta, Georgia. I focus mainly, obviously, on FHA, conventional, VA, your standard vanilla products. Then a couple years, 2021, we kind of heard something was coming into the loan market that would satisfy more of a self-employed investor niche. And therefore, brought to my attention in 2022 was something called debt service ratio financing, and this was specifically for investors. This allows investors to kind of take a break on all the documentation required, tax returns, W-2s, things of that nature. And the lender in this case is specifically looking, can the property cover the debt? The debt being PITI, the mortgage, principal insurance, tax insurance. Or interest and insurance. So this is kind of a turn from the past where, since 2008 and the crash, we have just asked for the moon from investors as far as qualifying. And I've heard it, believe me, since 2008 up until this new product, it has been pretty tough because it's backed by Fannie, Freddie, the government, that comes into play. So now we're dealing with the secondary market and a non-conventional market that says we're going to apply common sense underwriting to these loans. We like loans that actually can generate income. Mm-hmm. You may not live in it, but we like that. You can rent it. You can get money off the income versus a second home or, of course, your primary home. So this is a scalable situation now where you can close in an LLC. You can have as many properties as you want. You can even, in some cases, get gifts as down payments, which is tricky, and I can get into that a little later. But it's very flexible and it's common sense. And by the way, this type of lending lends itself to what's called exceptions, which they don't have in conventional in the Fannie Freddie world. It's either black or white guidelines there. Here, it is truly, we're going to look at everything. If you have assets, things that are outside the norm, they're going to try to make a deal work. Credit score comes into play, of course, too. So you got to have a 660, 680. But the exciting news, this is scalable. So with that, I wouldn't mind just going through the slides and talking a little bit more about it. I'll also talk about, since a lot of you investors on this are probably self-employed, there are some big things, and you may have heard about that you can use also to use to buy investment properties besides the debt service ratio loans. So, Matt, do you want to bring the slides up?
Yeah, I'll pull it up. And
okay.
Let me go back a little.
Okay.
Yeah, I think when I first heard you talk about these, I was really excited because I know for, say an investor who's, purchased their own house conventionally, there's limits on the number of conventional loans they can have or what kind of
Correct.
mortgages and things like that. And also, maybe they have a really profitable business, or they are a 1099 and they've had a great year, but there's not enough history, for traditional lending. And this really provides some great opportunities for investors to put those investments into real estate. And so thanks for sharing this with us.
Yeah, well, thank you. I'm excited to talk about it because this is my background. So if you want to go to can you bring up the slides up? There
Oh,
you
do
go.
you not? Yeah,
there it is. Right now I see them. Okay, great. Thanks, Matt. First of all, we are my company, Reliant Mortgage Solutions, is a full service broker. Residential mainly is what we concentrate on, but we deal with so many lenders with so many programs to try to meet today's needs besides your generic Fannie, Freddie, FHA guidelines, and VA. You can go to the next slide.
All right.
Or I can do it. I'm sorry.
Yeah.
I got the next screen. So non-qualified loans in 2008, when we all know, most of us know that there was something called the real estate crash. And they put into law in 2010 something called a qualified mortgage, part of the Dodd-Frank Act, which we live and breathe in our industry. So those loans were needed to pass certain tests. One of the big things that was needed to pass was the ability to repay. Before the crash, we basically were just putting incomes on applications and they were not verifying it. And in fact, there was zero down with no verification. And that led us to what we know happened in 2008. So they came out and they said, hey, all you lenders are going to be under the qualified mortgage atmosphere, meaning you have to do this, this, and this, and this to get a mortgage backed by the full guarantee of whoever's backing it, Fannie, Freddie, FHA, the government, and so on. Well, fast forward to 2016, we started to see some things that were considered non-qualified loans in our business. And what was interesting, we always thought, people who were in a long time said there's no way that we can, have these type of loans, or we're going to get, when we get audited, we're in trouble as a lender. But they decided in 2016, the regulation that, hey, as long as it's not by the government or taxpayers, if you secondary investors want to start creating products, you still have to follow a couple characteristics like the ability to repay. We're fine with it. You just won't get backed by our blessings. So guess what? That meant the rates at that time in 2016-17 were a lot higher for some non-qualified loans. And one of the first things that came out wasn't DSCR. It was more bank statement loans and asset depletion, which I'll get into a little bit later. So anyway, today is non-qualified. Any loan that falls outside of Fannie, Freddie, conventional, FHA, VA, USDA is called non-qualified. Most of that is what I'm about to talk about. And my favorite is non-QM for investors. This is what you want to listen to. The DSCR loan is called the debt service ratio loan. You'll hear it. You've probably heard it. Basically, all it does is qualify you for a mortgage based on the rental income the property can generate divided by the PITI. and an HOA. They divide that by 12 if there's an HOA. I don't know, Matt, if you see a lot of HOAs in your management experience.
Yeah,
with investors.
If it's new construction these days, it's definitely HOA.
Okay. So they'd include that divided by 12. So, it used to be when it started out, Matt, that it was 1.0. You had to have a 1.0. It had to be if the rent was 1,000, the mortgage couldn't be over 1,000. Well, they came up and said, you know what, we'll actually go down to 0.75 and things of that nature. We'll just limit how much you can borrow, and we'll require a little bit more assets in reserves or something. We started getting common sense. And in fact, fast forward to today, I have something called no ratio, where if the ratio doesn't work, they may still do 60% of the appraised value in a loan amount, so not bad.
Yeah. And as long as the investor's putting down 40%,
they don't care.
And they're not going to walk away from that, and so it's, it's treating it like a business. So,
well, let me tell you where this works well is, people who get private money, they buy really well, they fix up the property. Private money does not want to be 30-year fixed. We all know that.
Right.
They want in and out. They want to make, yields on their cash. And so they're moving on to the next deal. So this provides a way to do that, is to get in and out fairly quick, and not worry about the 1.0 ratio. You can go down to 0.75, and if you have that much equity. So buy well.
You make your money when you buy. That's for sure.
You got it. There you go.
This definitely gives those Burr investors opportunities if they're buying a property to flip, and they could do it with hard money and then refinance into this.
Something I didn't do. Personally, I didn't buy well enough. I was too excited to buy real estate. So I learned my lesson, but I myself had up to 10 properties at one time. So not a long story.
Yeah.
So anyway, again, I just calculate for 101 classes, and this is not a 101. I think you got seasoned investors. I have this slide kind of showing the example of a 1.0. There's your rent divided by the mortgage. And but again, things have updated lately where you don't need a 1.0. So call me if you have any questions. On to the next slide. Again, there's where I talked about the 0.75, Matt. And in fact, they have 0.5. And in fact, they have now no ratio. So, they're going to play common sense in this. If you don't have 1.0 and they'll loan you up to 80% of the value, they start backing down or they start requiring. It's common sense, which I like. Mm-hmm. It's not, you don't fit the mold, you're out, not approved.
Right.
And again, no limit on these properties or anything like that. So what this does in your portfolio, DSCR for investors, it allows for future growth. It's flexible underwriting that allows to focus on the next property instead of making sure you rent that one, then you get a 70. In the conventional world, you can still get financing today, of course, and they do give you the best rates. Now, it's interesting because the rates have come closer because the demand for DSCR loans is so big in the secondary market. So we're seeing about a quarter spread, sometimes higher, meaning if you get 6.5 with conventional, you get 6.75 with DSCR. And there's some other factors, but that's kind of in general. But you can scale this because no W-2s, no worrying about renting the previous property, and the underwriting saying, give me a lease, using 75%, calculating debt to when you start owning so many properties, the complexity of conventional lending is unreal. I've had investors where they've gone, and you can get up to 10 in conventional. There's 10 properties and I need help trying to calculate tax returns, rents, and even the underwriters do. So this allows growth fast, but smart. It limits the loan to value. Again, they're going to let you allow at the most 85% of the loan amount, the value in a loan amount. They'll go up to 85%, and they don't have PMI, by the way. Imagine that, non-conventional. Now, the rate goes up, obviously, to cover it, but they don't have PMI. No cap on rental properties, again. You can have as many as you want. which is the beauty. And there is no cap on that. And again, I keep reemphasizing the free from DTI. That's the debt to income with conventional, as we all know.
Right.
Go ahead, Matt. You have a
and
question?
closing in an LLC. So I know
yes.
a lot of investors worry about liability. Maybe they want a little bit more privacy or things like that. And but if the lending is attached to their name, it's a little bit trickier. But being able to close in an LLC from the start really helps in protecting those assets.
It does. And not only in LLC, you can actually close in trusts and I think S corps, which is a little trickier. And just a reminder for anybody who has LLCs, and I've run into this recently, because the beauty is what I love personally about DSCR loans, I'm licensed in Georgia, Alabama, and Texas. However, with debt service ratio loans, it's considered a business loan outside where I need to be licensed. So I can license up to 38 states as long as I have a license in one state as a LO. So again, they treat it as a business transaction. That gets the investors out of all the hassle of the conventional world, and it helps me because when they audit my company, which they did last week, they don't look at these loans. It's like now there's other parties, but the biggest party that comes into brokers' offices is the Department of Banking and Finance with Georgia or Alabama or Texas. They don't come in and look at these. This is more if they hear of problems, they'll seek it. So it's not the Wild West, but it's less looked at because they consider an investor experienced, seasoned, and knows what they're doing.
Right.
And this is the beauty too. Besides the LLC, this is probably somewhere in the notes. You can also take prepayment penalties on these. You can on any conventional loan. You can on these. And why would I do that? Well, if I show you could get a half a point better by taking a 3 to 5 year prepay, you may like that. The lender is allowing that. And I'm seeing 70% of my clients take prepayment penalties because the rates really get better because they know they're going to keep the loan. They're always worried. Lenders are always worried about getting paid off because the servicing they get money in that. They want to keep the loan. They want the yield. So they're really incentivizing investors if they'll take a prepayment, and they're not that bad. The prepayment penalty is sometimes 1 to 5% of the balance. But that's the nice thing to do, to be able to bring the rates down. Can't do that in conventional for investors.
Right.
Think of that.
Right.
All right. Next slide. Advantage, no tax returns, no personal incomes. We know that. Threshold, DSCR threshold, acceptable. And this was old. So my assistant, who I think is on this, can update this slide. We have it. I know it's 0.5, and in some cases it's no ratio. Here's some requirements: 680 credit score, no prior landlord. They've changed that. It used to be, Matt, you need to have some experience, right?
Right.
So most lenders took that away and said, hey, I don't need it. If you're a first-time investor, go for it.
Right.
We feel good about giving you 80, 75% loan. And when I say that, remember, you're going to be required to put 20% down. Now, you can do 15%, but the rate's really high, 20% at least on a purchase. And then we'll talk about cash outs later.
Which on a conventional, it would be at least 25%, right? For
investor, yeah. Well, the investors allow 20% on conventional. Here's the problem: from 75% to 80%, there is like a 1% tack onto the rate, so it's awful. So if you get a 6.5, that's 7.5 just by taking 5% more. So they're really not forcing you, but suggesting you put 25% down in the conventional world. They don't let you close in an LLC. Now, you can quick claim out afterward or quick claim to an LLC after the closing. A lot of people do that. But I didn't mention this too, and I'm skipping around. This is another thing we're talking about companies. Since you close in an LLC in the DSCR world, this doesn't show up on your credit report most of the time.
Right.
The interest gets reported to the EIN number, employment number that your LLC got when it filed with the state, right? It gets a tax number. So a lot of times these things aren't showing up on credit reports.
Right. Yeah, which is great because you can run into some real limits on, on the number of deals or things that you're trying to put together. Yeah, I run into a lot of first-time investors who are playing games with conventional. They don't put down enough. They don't realize how much their monthly payment is going to be in comparison to what the projected rents actually are, so, and they play a lot of those games, and it really seems like this frees up a lot of opportunities for them.
And you said cash flow is a problem sometimes, right?
Yeah.
Matt, this allows you to do interest only. All loans, all DSCR loans have interest only now. Not that I think in certain situations it works for an investor who's going to hold it 5 years and you're not going to pay much down anyway, but you get the cash flow. And that helps with your DSCR ratio. Remember, they'll still go down to 0.75 or lower, but it's not for free. If you go over that 1.0, you get hit in the rate, right? They're going to, and then they're going to loan you less. Well, guess what? They take the interest only payment. Okay. Which helps.
Yeah. And I wonder too, with the no prior landlord experience, do they factor in working with a property manager as investors are buying these properties?
While you were sitting there, I was thinking of that when I said there's no landlord. I was like, what if you have? I don't know. To what I've heard, and I've talked to many of these DSCR, is they feel more comfortable with a property manager in place when they're doing. Now, I don't know what that means, right? Because you're licensed, you know what's going on. Remember, when you're doing a purchase, you don't have a lease, so they've got to take the rent comp in most cases. And sometimes they'll ask the property manager, the appraisers, to supply them some comps. So the whole process is better with a property manager. They feel you got a licensed individual. It's a company who's going to make sure their collateral, they're lending on it, is taken care of. Yeah. Okay. Cash outs. This is big, Matt, and this is big on here. This is where I see a lot going on right now. So many people, or there's a lot of people who have equity. They've had rental properties forever and they've lost their job. They have started a new job and don't have the 2 years of tax returns of conventional. They're like, I'll never get a loan again, but I have a lot of equity in this home that I've been renting. There you go. They'll go up to 75%, in some cases 80%. Cash out. That's what conventional does. So you get 75% minus your first mortgage in cash, minus some closing costs, back to you in cash. And what I've just learned is on another slide, since we're talking about this, they used to have you wait a year before you get cash out. I think that's come down to 6 months, or in some cases, no months. I have a lender that calls me every day and says, hey, we're going to scrutinize the appraisal, but we'll allow you to take cash out day one after you're getting ready to get your financing from your private loan you have or your cash that you put into. So it's interesting. Gift funds, I said that. Tricky, but it's been done, because in the conventional world, you can't have a gift. You're an investor. There's no way. Now, the gift does have to be for somebody. If it's a company that needs to have some ownership in the property, we can get into that, but they are allowed, which is unreal. You can have up to 30-day delinquency on a mortgage in the past 12 months. And cash out proceeds can satisfy reserve requirements. So a lot of our lenders say, hey, we want to see reserves on the property you're refinancing, like 6 payments somewhere, whether it be a 401, stocks, bonds, whatever. But if you're getting cash out and it's 6 months, we don't need to show any of that. That's it. There's your cash out. There's your reserves. It's great. There's the prepayment penalties and the interest-only option. Love it. I would say 70% of people are taking the prepayment penalties. And then interest-only, I'd say around 25%. Most people want to amortize it and pay it down. Look, I like amortization. I personally do it, but I can see why an investor who's not going to own it forever may take interest-only. I got the analysis for that. I can get into it. DSCR's available properties are currently occupied. So it can be occupied or not occupied. It doesn't. A lot of people ask, hey, if I refinance, does the tenant have to be in there? No, not necessarily. The loans allow for LLCs. Short-term rentals, the third bullet point. This is key. So in the world do you have a lot of short-term rentals?
The owners of our company do have short-term rentals. We aren't actively taking on short-term, but we are doing pad split. So it's like a room rental model. So we just launched our first one in December, and our next one's coming on in February. So
one of my first DSCR deals was in Atlanta. It was pad split.
Awesome!
It was an interesting, short-term.
Because it's hard to figure out financing on pad. It's hard to figure out financing on pad splits.
It is. And what we did, the lender didn't like it at that time because short-term rental, it was very hard up until about a year ago to figure out what's going on. It wasn't so much in Panama City or up in the mountains, but in Atlanta, that was. So what they have done is they go to something called AirDNA now. And you investors out there, if you have short-term rentals, they're going to use that. And the beauty of that is you kind of know by going online. And in fact, they take away the rent comps. If you don't rent it month to month, they won't require rent comp. They're basically going to go to this AirDNA. And then if it's a refinance, they will confirm with the property manager. They may ask Matt, hey, can you provide me last 12-month statements on this property, P&L, profit, rent versus some losses, whatever. So it's interesting how they're looking at short-term rental in the past year. They were real picky about that. That one pad split I did, luckily they had a lot of equity and they were allowed to go down. I think at a 0.75 because they had to do it as a pure monthly rental, even though it was going to be short-term. And then there was some question about the zoning laws and all that, but it's fine. Pad split, got through that. I know there's a question about pad split and that, but it was fine. And no cash out seasoning. That's what I survived with off 2005 and 6. Cash out until the day you die. We were telling everybody, it was non-seasoned. People would buy cash with their cash or private money from somebody and then get an appraisal. Well, there were some draws in that too. So most lenders today want you to wait 6 months or a year to use appraised value. They will let you do a cash out if you bought it for 100 using cash, but you think it's worth 150, they'll actually do a cash out in most cases at 100 and give you 80% of that. Most people want the true value and do 80% of that. I have one lender now that's telling me they will. Now they're going to scrutinize appraisal if it's before 6 months. So we'll see how that works. But hey, I'm seeing a lot of confirmations from these lenders work when they tell you something. It's a common sense thing.
Yeah.
Who should consider it? Emerging seasoned real estate investors, just anybody who's going to buy rental property, self-employed, seeking investment financing, investors refinancing products regardless of occupancy. What that means, regardless if it's occupied or not. So a lot of partners getting together, putting their money together, doing this. They're creating LLCs. It's pretty nice financing. Other non-QM loans, Matt, bank statement. For your self-employed out there, bank statement loans, we look at 12 or 24 months, look at the deposits and just average that. You can do personal, you can do business, but you have to be self-employed. And then we average it and then they apply expense ratio and then they come up with income. No tax returns again. 1099 loans, no tax returns. We look at 1099 and then they apply expense ratio. They got to apply, you're a business, They know you have expenses. They don't want to look at the returns. They want to look at your P&L to say, or they apply their own loss to it based on your business. If you have inventory, not a percentage, usually it's anywhere from 30 to 50%. And then your income is over that. Per month, they give you credit for. These programs consist of cash flow and true earning potential, making it's for the entrepreneur. It is for, self-employed individuals or investors who the traditional way of financing will just not work. It is, that's all I could say. And it's pretty flexible, especially if you have liquid assets. Document qualified based on there's a 12-month statements that looks at the bank statements. It can go up to 80% bank statements. Hey, besides an investor, if there's an investor out there that wants to buy their primary, they go to 90% bank statement loan, so you can only put 10% down. Expanded property eligibility, condos, duplexes, everything is eligible in DSCR world and bank statement. Remember, just doesn't have to be a single family. It can be the quad. 5 units, It gets a little tricky. It's considered more of a commercial product, but I think we can get access to it. First-time buyer access, no prior home. Look at that. I thought you at least had to own a home when I first started doing this. And because there's been some questions about, is he really moving into it, but using the DSCR component to qualify? But they're like, no, we can weed that out. So they're saying you don't even have, you can be renting from your parents in the basement, buy a rental home with this stuff, or not paying rent. How about that? I wouldn't do that for my kids. They'd rent.
Right. They need some incentive to get out.
They're not in my basement.
Yeah.
So
we do have a property where it's an adult child that lives at home and bought her first investment property before she bought her own home. So
isn't that crazy?
Yeah. So, I think everyone's investment goals is different,
It is.
And
it is.
There's definitely opportunities out there. So
bank statements, again, I had these slides presented for 101, but it's flexibility. We're looking, you can get 30-year terms. You can do interest only in bank statements. I just closed on a bank statement loan. I want to say it was a $10 million property, and she's borrowing like 30%, really very few questions. And she had 3 restaurants, just a great product. And, the returns probably said I never asked for a return. She said, I know bank statements. I want to do bank statements. I'm like, okay. 1099. This is where somebody's 1099. Again, they're going to look at a year or 2 years 1099 and average it. And then they're going to apply maybe 20 to 50% expense ratio. 1099s can be quite high. It's when they flow through the returns, we see them drop dramatically.
Right.
So eliminating the returns and the lender applying a common sense expense ratio helps a lot of people get qualified.
Right.
P&Ls, this is one I haven't done, in all honesty. Because CPAs do not want to put their license to this. You can get a licensed P&L from a licensed P&L, a licensed CPA to do a P&L. Good luck, but they're out there. I've heard some closing where all they ask the accountant to do is put your profit and loss, and they may lend 75% of the value on that. And it could be rental property. So I don't know. It's one of those things, primary rental. I have not done it on a P&L, I'll be honest, but it's in the guidelines. All right. This is me. There's my number. I love this stuff. Obviously, I still do the gravy stuff with conventional and FHA. I'd love to do that and talk to you about that. My team is great, but we're we could do complex investors and things of that nature. Just that's in my background.
Right. Absolutely. Yeah. So I'm just thinking a number of times when I encounter investors. So unfortunately, a lot of investors come to me after making a series of mistakes. Mm-hmm. They randomly choose a market, without talking to anybody, but they they heard it somewhere, or they, searched online and somebody said it was a great, market. They overpay for a property.
Yep.
They do rocket mortgage, or they're trying to use their credit union. Or, especially with new construction, the builder is funneling them towards their mortgage broker, because they're trying to, churn fees there. But I think, to me, one of the reasons why I really love sending investors to you is the financing piece really is the most important part of the buying package. Being able to negotiate, you have to come in with a strong financial position, and having a lender who has multiple options, can figure out the strongest offer possible, and create more outs for the investor. That gives us more bargaining power, more negotiation when it comes to getting a property under contract. But I always, Sean's the first person I want to connect investors with as they're thinking about this, because there's so many misconceptions, and unfortunately, it comes down to losing a contract, losing a deal, because we can't get a lender on the phone. The initial pre-qual wasn't accurate when they actually started digging through things, and they're not qualified for the loan they thought they could use. So that's just some of the red flags. How about for you? What are some red flags that you see with investors where you're trying to correct misconceptions that they might have about the market, about the finance process?
I'll be honest, a lot of the investors I work with are pretty seasoned. It's the agents who call me that are confused a little bit. I try to put in my letters conventional financing, which it is. It's a conventional loan limit, but they're like, I heard he's going, what's this debt service? So I have to talk to them about that. From my standpoint, it's dealing with the agents and letting them understand, hey, they're a strong borrower. It's just a different product. It's investor type product that, it takes a little bit more doing on my part. I make the investor feel good. Hey, I don't need returns. I don't need, because they come in and thinking, oh God, here we go. It's another, tax return from what year and this and that. And the documentation level, the misconception is, I've got to give a lot of stuff. I got to take time off work to get this. And you don't with these loans. I mean, it's literally, here's an application. I need maybe an asset statement, and I need to get a lease from Matt or something showing what your rent payment, if it's a refinance. If it's not, just give me give me the contract and an asset statement. I mean, you got to sign documentation. Right. I think the documentation scares investors. I think they don't understand this product. They think it's like 2 points higher, and it's, we're lending in a cave or something, right? No, it's a normal closing attorney. Right. It's this. Investors, you can expand. You can use this to your advantage. You can use interest only. Right. Prepays. It is truly banks and insurance companies buying these loans.
Right.
In fact, they're coming to me and saying, I want more. I'm like, well, make the guidelines easier. So there's just a lot of miscommunication out there.
Right.
And the cash, it's still, they still think, oh, I don't have jobs, or I don't have regular jobs, or maybe I work part, I can't get loans. I'm like, no. Right. This is built on the property. It's collateral.
Right.
What can it generate? So
and that's, I think at least from my experience, these aren't fast loans. So you still need like a 30-day.
You need a 30-day close.
A 30-day close, right? So that is one area where this is a little bit different. It's not something where you can say, hey, we'll close in 14 days. Like you probably could with a conventional if you're pre-approved and it's just kind of qualifying the property. But from the other.
Did I answer your question, Matt? I want to make sure when you said misconception, I want to make sure I know what I hear when they come to me as they're surprised how easy it is. Now it does take, you're right, it's a full 30-day close.
Right.
Because there's some other things they look at, and it deals with the property. They scrutinize the appraisal a little, make sure the rent comps are okay. It's really, too, how long does it take to get the appraisal back? There's a little bit more work on their end. That's where, because that's an important piece of this, is the appraisal.
And these are banks too doing this.
Yes.
They're on bankers' hours, and
the bankers' hours are different. It's not Sean Trombetti hours.
Right.
You call me, Matt, we'll talk on the weekend.
Yeah.
I don't mind.
That's right.
You got somebody? I got your money, hopefully, right?
That's right. Yes. Yeah. So, because it is qualifying the property, it does take a little bit more time, and probably about 2 weeks to get the appraisal completed and back.
That's it.
And, then somebody in a bank is reviewing it to make sure everything's writing. So,
and most of the lenders, they are banks, but they're not the bank department. They are branches of the bank called wholesale, where that bank has said, I'd like to create a branch with a little bit more what they deem risk. I don't think it's risk. Mm-hmm. So it's actually tied into a bank, but it's a department. They say, hey, buy these loans. This is great. We'll put them in our portfolio and stick them in our bank.
Right.
So, so it is a bank, but it's a different branch.
Yes. And this is where, I really think you're a real asset to an investor, because I've just spoken to so many, I've called so many lending these big banks that do loans where you can't ever get the mortgage broker on the phone. They don't respond, but that's when deals happen, right? It's like Friday afternoon, you're trying to get something, under contract, or it's over the weekends, and it's like, well, hopefully they respond on Monday, but they may be on California time, and we're not going to hear anything back until afternoon Eastern time. So, having a local lender who understands the market, but also can work through those misconceptions, but those are really important before you end up doing the dance on whatever deal you're trying to get into. Which, as an investor, you want to move fast, but you need to be prepared in advance.
You do, and I am available Monday through Sunday. I've done this for 23. I wouldn't stay in business and have 254 Zillow reviews,
right?
If I didn't work on the weekend. So, and I do appreciate, Matt. You're a great guy. Just your knowledge in the property management, and I'm going to tell the investors again, using a property management company in this transaction, not so much conventional, but the DSCR world, debt service, can help a lot.
Right.
I won't point out the specifics, but there's some understanding from the lender and a licensed individual like that, especially, like any licensed agent too.
Mm-hmm.
You're a licensed property manager.
And that's why I really like working on the acquisition side, because, when somebody comes to me after they've already bought a property that they either overpaid for, overfinanced, they have very unrealistic ideas about what they can get in rent. I'm the bearer of bad news when I'm putting it on the market and telling them, hey, it's going to be cash flow negative. When you start a business, sometimes first couple of years you got to put money in, and sometimes that's just how it is with investments. But it is very painful to be the one, after they've gone through all these things, to be like, hey, but for them to be, not have enough cash reserves, not really, they went in naive and over optimistic and didn't really understand what they were getting into. And that's a real hard position for us to be in, because what if something breaks? Do they have the cash to fix it? Are we even stuck with a tenant who's upset? And so
that's the beauty, Matt. We're going to help you. Our appraisals are legit, so it's going to tell them if it's not occupied, what the rental market's going to bear. It's usually within a 5% error margin. It's close. So,
and one thing we haven't talked about, but we know there's the locked in rate. Some people their primary house, they, may be worth 500,000, 700,000, and they have 2.5% mortgage that's 300,000, but they got all this equity, but they don't want to refinance their house. What could you offer them that might help them pull out some of that equity without having to fully refinance?
They are a victim of the Federal Reserve from 2020 or 21. I am too.
Yeah.
But what I did was I got an equity line, as much as I could get on my house. We offer those too. That can help you buy investment homes. In my case, it helped me buy the second home. I don't rent it out. In fact, I'm talking from it here. So you can leverage some of that money as long as you leverage it not for bad debt, for an investment that will go up. And what we're seeing, you correct me, here in January 2026, some softness in the market, that there may be some opportunity for investors. Because I'm starting to get the calls.
This is a great time to buy. And really what I really want to highlight for investors is the real values with new construction. There is so much opportunity with new construction where builders are offering $20,000, $30,000 in incentives just from trying to get product offloaded that they have to churn. They have to sell a certain number of properties just to keep the machine going. And right now with existing, there's a lot of homeowners, owner-occupied homeowners. They bought at the peak in 2022, and they don't want to take a loss. They'd rather stay in it, or they want to rent it out. And so it's still kind of a stalemate in the existing market. But in new construction, those builders are trying to move properties. And so actually right now you can buy new construction cheaper than you can buy existing, which is crazy.
Oh my goodness.
So when you think about from a landlord perspective, the amount that you're going to have to put towards repairs, for the next 10 years on a new construction compared to existing, there's no rehab. There's no,
Oh, I know.
And so, hands down, I think that's the real opportunity for the next 10 years. Buying right now is with new construction in some of these outer, Atlanta upper northern suburbs, where rents are reasonably in line with home values. So, average home price around Metro Atlanta is $400,000, and rents aren't $4,000. So, you got to go a little bit to the outskirts where you start seeing, properties maybe just under 300,000, where rents could be about, 2,500. So
yeah, there's some opportunity there. I see. Yeah,
absolutely.
New homes. It's interesting. Yeah. So I am getting the calls. We'll see. I think everybody's waiting. We talked about rates so much and the Fed. We did get a new Fed member today, or chair, and he's hawkish, which means he's in favor of cutting. Very, very much so. So we'll see what goes on when he comes in May. So.
Right. Absolutely. But yeah, there's still a fair amount of distress out there, and if you have cash to buy, you got a lot of bargaining power. So a great time to give you a call to get geared up and buy your property in 2026. So
yeah, that sounds great. Really appreciate it. I'd love to work with as many investors out there. Look, I'll be honest, we can pre-qualify you in an hour. It's not a big deal. I mean, a lot of it's going to, if it's DSCR, it's going to, the collateral is going to have to pass most of it. You just got to have a credit score and some assets, a decent credit score, 680 and up. So
right, absolutely. Okay. Well, Sean, thanks so much for joining today to help all these investors learn more about DSCR loans and options for purchasing investment properties. So if you're listening and you are maybe in California or New Jersey, and the idea of a starter property out there is the cost of a small island, Georgia is a great opportunity to invest, and would love to connect with you. So feel free to check me out, mattmartinhomes.com. You can catch me on LinkedIn or Instagram as well. And you can reach out to Sean at Reliant.
404? Yeah, Reliant. Yeah, 404-641-1486. Facebook, companies on Facebook, Instagram. Would love to talk to you.
All right. Awesome. Well, thanks so much.
Thank you.